Bonnie said you were great to be alone. Good morning, everyone. We're back to session 19, chapter 20 about investments, and so I will start the. I'm going to say hi to everybody, and I'm going to ditch the camera, stop my video, and we'll start our lesson today. I can see the recording is in progress. Hallelujah for that. All right, so I think I thought I was, there we are. So today's agenda is investment income. We're going to do the TPS for investment income, carrying charges, RSP contributions, home buyer amount, and workman's comp and social assistance. They just kind of throw that in. It doesn't really relate to investment income, but we need to know the proper data entry. So at the conclusion of this lesson, we should be able to make the necessary entries to report different types of investment income and claim related carrying charges on the tax return. We will learn how to enter investment income from Canadian sources that are not reported on a T-slip, and how to enter investment income reported on the T5008. We're also going to include RSP contributions on a return, either for deduction or carry forward. We're also going to apply the home buyer and lifelong learning to a tax return regardless of whether the taxpayer made an RSP contribution or not. We're also going to show how to make the applicable entries to claim the home buyer amount for an individual as well as for joint owners. And we'll learn how to properly enter workman's compensation benefit and social assistance benefit on a tax return. So, as usual, there's no more information on the PowerPoint, so I'm going to go to our in-class exercises. So hopefully everybody has their in-class exercises in front of them. I'm going to bring up my DT Max. And I'm hoping by this time everybody is good with their DT Max. We still had students on Tuesday, and hopefully everybody, I think one was in this class, I hope everything's working for you now. And let's see here. Okay, so we're all set to go. So our in-class exercise is Lillian Richards, and so the first thing we're going to learn about is the how to enter investments. So the data entry that we use for employment income is T4s. So the data entry field we use for investment slips are T-slips. And if we look at the T-slip menu, there's a lot of slips to pick from. So we're going to look at Lillian Richards. So, of course, I already have Lillian Richards. So let me bring up Lillian Richards here. Oh, there she is. So we have Lillian Richards. I'm just going to close the data. So we have Lillian. So please go ahead and fill in the personal information for Lillian. I will bring up her mailing address too. So you can do that. So create the file. She doesn't have an email address. So if a client doesn't have an email address, what are you going to put in the email data entry field? Nothing. You're not going to, can you open? No, you can't. But Abby, you're right. No, nothing. Do not write no email. Just don't enter anything. There was a question, can you open up 2 DT Max windows at the same time? No, you can't. You can if you're using a T2, T3, so you can actually have a T1 open and a T3, but you guys don't. You guys don't do T3s or corporate, right? So no, you can only have one. If you have 2 open, it'll tell you that that the password is invalid, so you can't do that. All right. So let's work on Lillian. Hopefully, you have her personal information in. So we're going to look at the T-slips. So we're going to go down here. I'm going to close her mailing address, and I'm going to go to T-slips. And we already put a bunch of T-slips in, so I'm going to go to T-slip here. Here's all the different T-slips we have. We've seen some of them. Some of them you'll see on a regular basis. RC62, you probably won't see that unless you're doing somebody's return from 6 years ago and they had the universal child care. We have a T3. We have T3. So the T3 income, that would be in U.S. We have, you can enter T4s here too. T4A, T4 Old Age Security, T4AP, that's CPP. We have T4E, T4 Profit Sharing, T4 RIF, T4 RSP, T5, T5 US. We'll be seeing T5007 and T5008. Those are probably the most common ones we see. Sometimes you'll see a T5013, which will make you tear your hair out, but we really don't see a lot of those. And if you got one, I would certainly, if you got that in a first-year setting, I would definitely ask a senior tax pro to help you with that one, because we don't do that one. It's a very challenging one. So, so those are the T-slips, and I'm just going to close it now. So it says here Lillian's a teacher, and so she has a T4. So everybody fill in her T4 too, and then we'll just get, so her T4 should be pretty standard. So I'll give you a little bit of time to put in her T4, and then we'll start putting the investment income in. So hopefully you've had a chance to put the T4 in. All right, so T-slip. The first T-slip we have for Lillian is a T3, and so we have all the box numbers there. We also have an item called footnotes, and in the footnotes it says IMA fees. So those are management fees charged by this investment company. Now, a lot of times clients can get letters from their broker or the investment firm, and they'll have a letter that has their management fees. Sometimes it's on the T3s and T5s. So this is why it's really valuable that if you do the AFR in the office and all the slips come in through on the AFR, it will not have the management fees. So it's really important to actually look at the slips that the client brings in, because it could have this information. And I'm telling you right now that in H&R Block, the people who test you are always sticking in management fees on the T3s. They're not going to write it in. They're going to stick it in there, hoping that you miss it, and then you won't get a very good mark on your TPS exam. Right, man?
Yep.
That's right. Okay, so the other thing they want me to point out is that, you know, the software does actually calculate the taxable dividend and the dividend tax credit. So they're advising me to tell you not to enter it. I mean, I'm in a state of conflict about this because when it comes through in the AFR, you're copying it. So really, you're not doing a lot of data entry in the office. So for me, I did put it in, and it's up to you. I'm supposed to advise you not to do it because the TPS will gross this up, and then they'll calculate the eligible dividend taxable credit, and it will calculate the dividend tax credit. So, but they told me in this chapter, they've told me about 5 times to make sure you don't do it, which to me saves a millisecond of time. So let's look at the T-slip for Lillian. So, so we have dividends, and so you put the dividend income in. She also has other income. Let's just expand the whole. We expand the whole grouping. There's a lot of things that can be reported. So in this case, we have box 4951. We have other income, which is box 26, and then we have foreign income here. And then we have capital gains and losses. I'm going to come back to the other field at 0 in a minute. So we have capital gains and losses. So this is basically probably mutual funds, and so this is her share of the income from holding these mutual funds. I don't know if you recall when we were talking about investments in the theory part, there's the case of spouses filing together. And if one of them has dividend income and that they can't use it because they have low income, the TPS will automatically transfer the dividends to the higher income spouse's returns if the action creates or increases the spouse or common law partner amount. I'm mentioning that. I know that in one of the practice problems we're going to do today, we're actually going to see that in the TPS. The other thing that you can do with investment income here is if you go down to here, it says owner's percentage and share. So sometimes you will have situations where, and you'll see it actually on the T-slip, it's jointly owned by, it has both names on it, both spouses' names on it. So in that case, you would put the T-slip on one of the spouses, and then you'd have to ask the client what is the percentage. Let's put 50 cents in. Let's say that, 50% I meant, sorry. So 50%, let's say that, now Lillian is a widow, so it's irrelevant. So let's say that she did have a spouse, and it was held jointly. It would be 50%. Well, we'd ask, let's assume 50%. And then the software asks you, do you want the remainder to be transferred to the spouse, particularly if you're doing linked returns? So yes, you would, or you can ignore the remainder. So so that's a really useful tool, and we will see that. Let me just move on to the next. Okay, there's a question. Why do you have box 25 in box 24 plus? Okay, so that's a good question. So let's go back to that. You'll notice that there is no box 25. There's no box 25. So you go to box 24 plus, and you have to select whether, because foreign income can be dividend, interest, or business income. Now, you're not going to see the business income because that's generally on a T5031, which we already talked that you're probably not going to see. All right, so you have to select, and I will come back to that. And Thane's asking, where do you enter the management fees? I will do that later in the demonstration. We're not doing it right now because it doesn't go in the T-slip section. All right, so just hold your horses on that. Anyway, I'm just following along what it says here in the in my instructor guide. So sometimes currency on a T3 could be reported in foreign currency. So this amount should be entered as reported, and then the currency converter at the top of the T-slip group should be used to convert the foreign amounts into Canadian dollars. So let's just look at one of those. So I'm going to go down to the T-slip here and show that you have T3 slip US, and it asks you what is the exchange. So our database actually has an exchange. It has the annual rate, so this is for 2021, the annual exchange rate for US and a lot of other ones, but in this case it's just US, and so you would select annual. If you actually knew when the person got the income, if they got the income in a lump sum payment, you could select the month it was, right? However, we're talking about dividend income. We don't know when they got it, so we're going to select annual, and the annual rate, then you have to actually type in the annual rate, 2535. So then what the TPS will do is you're entering U.S. income in here, and the TPS will convert it. So I'm just going to take that out. That was just for demonstration purposes. We will see that later on. So let's go back to our horizon here. So we go back to horizon. We do have some foreign income. Now, in this case, when you're dealing with a Canadian broker and there's a foreign income, it's already converted, so we don't have to worry about that, right? So foreign income. So the foreign income is box 24 plus, so it probably could be box 24 or 25. You don't know. Here it says it's box 25, but we don't have a separate box 25 here. So I think it's 25, and yeah. So how do I know if it's foreign income? How do I know if it's interest income or if it's dividend income? How do I know? Well, you're going to just have to commit this to memory. It is, they did discuss it in the TPS manual in our chapter, and basically we have tax treaties between the U.S. and Canada, and so if a Canadian receives U.S. interest income, there is no tax withheld. That is due to the tax treaty. So If there is no foreign tax reported on the T-slip, that means that the foreign income is interest. So that's why I selected interest, because there's no box 33 or plus. So then we have to put 0 in here. So even though there's no entry in her T-slip, if it's foreign interest income from the U.S., we put 0. We know that the foreign tax is 0. Now, I'm actually going to just take this out because we don't have it, because I want to show you what happens if you don't do it. So let me just go here. To claim the sometimes you can have a foreign tax credit. So if it was dividend income, there could be a foreign tax credit, which is a level 2. We're not going to go into the foreign tax credit. So point out the fact that, so foreign income is been reported on box 25, and we're going to select interest income, and then we do have to do the foreign tax thing, but I'm not going to do it now, all right, because I just want you to see the error message. So hopefully you guys have just put in the, you've got our T4 in there, mailing address. I'm going to recalculate the tax return, and look what happens. And if you recalculate, what does the DT max? Are y'all getting this error message? Foreign income, it says foreign income missing the corresponding foreign tax. But we weren't given any foreign tax on the T-slip, right? So that's why I wanted to show you the error message. So hopefully, if you let me know in the chat, did you guys get this error message? Okay, so let's clear the error message. What are we going to do? We're going to go to key. We're not going to ignore it. We're going to go to keyword, and then I'm going to close. Go to keyword. They're basically saying, where is the tax? Well, there's no box on the T-slip. So we're going to go to foreign tax, and we know that it's interest income because there was no foreign tax paid. We're going to put 0 in. Now go back to recalculate the client, and now there's no error message. All right, so that's what we need to do in that situation. And I have to tell you that from 10 years of doing this data entry, it's so irritating to always have to go back and do that, you know. So anyway, so let's just go to her investment worksheet. Now you're going to not have as many entries as I do, but we put in her box 21 so we can see some of the investment income. We can see the box 25 is here, and we can see all of her investment income. Oh, here we go. So we go to here, and we can see T3 Horizon investment. So this is eligible dividends. You can see that it's the taxable dividends, and then we can see, I think that's the only thing from that T3 on there. So, all right, so we're going to go back to the data entry, and we're going to talk about the T4 profit sharing. Why is it not in here? Oh, that's because they didn't do one. Okay, so another type of investment slip is called the T4 profit sharing. And basically it is entered on T4PS. So let us go to the slip and go profit sharing. Where is it? There it is, there, profit sharing. All right. So again, the boxes look very similar to the other T-slips. And in this case, capital gains are reported in box 34. So let's go to box 34. Right here, it says capital gains. So they want us to go to, let me just see. If there's dividend income, it's going to be in box 30. And again, they want to emphasize that you don't have to put in all the boxes. You only have to put in the actual amount. Also, in the case of profit sharing, is that an employee could be identified as a specified employee in box 40. So let's go to box 40, and it says specified employee. Well, do any of you guys know what a specified employee is? Yeah, probably, Bonnie, you're right. A rich one? Probably. Well, you know, I'm going through this, and I've done this course many times, and I'm like, what is a specified employee? Well, luckily we have help for keywords, so let's go click on help for this keyword. And what does this tell us about a specified employee? A specified employee is an individual who is dealing with an employer in a non-arm's length relationship or who has a significant equity interest, 10% or more, in his or her employer. So I find it puzzling that we're talking about this concept in our TPS application, and when we go back to our theory, they didn't even mention it. So again, I think this is because we're trying to show you how to handle everything, even though they didn't talk about it in the theory, which I think it should be talked about in the theory course. So basically what we're trying to show you is what the software can do. So let's go back to the T4 profit sharing here, and then I'm going to put in, they want me to put in some numbers, so you can do it too, but it's not in your in-class exercise. So we're going to say, yes, she is a specified employee, and we're going to put in box 35, we're actually going to put in profit sharing plan income of $4,800. I want you to do that. Just a second. All right. Then they also want you 48. Oh, and they want us to put that amount in 48. They want us to put it in here too. 48 here, 48 there, and then they want to say that yes, she is a specified employee, and then basically what happens is let's just recalculate her return. And so what happens with the profit sharing is that, of course, it goes to the proper boxes, but it also creates a form called the RC39. So that's why they want us to show you that by us putting in this data entry, it brings up a form called the RC359, which is tax on excessive employee profit sharing plan amounts. So I guess the thing is that if you're a specified employee, you may have some control over your employer, so it's non-arm's length. So basically the government doesn't want you to get away with getting this income without paying tax on it. So you'll notice it says here, if you're a specified employee, you have this amount of contributions, and they're going to make you pay extra tax on it. So there's going to be tax on the excess profit sharing plan. They're saying that it's excessive, that this person got $4,800, therefore we're gonna tax you on it. So a special tax. Again, I've never seen this in the office. However, perhaps you'll come across it in your years. So now we're going to go back and go back to the data entry, and they want me to make a change in the data entry. We're going to enter $15,000 of income from the same company. So we're going to go here, and we're going to put in right here, enter the income from the same employer. So now they're saying, yes, she worked for them. We're going to put $15,000 in. We're going to hit recalculate. We're going to go back to this form, the RC359. And you'll notice that now the excess amount is a lot less. It's not $4,800, it's only $1,800, and the excess tax is $963. That's all I'm going to show you. You're not going to be tested on this. We're just showing you what the software can do. I'm going to take this out right now. Does it? Yes, it does. It does. So if you actually look on, I think we had an example. No, yeah, there would be a little box. So you would know that if you look here on the box, very bottom of the box, it's going to say box 40. Actually, we do have a T4 profit sharing in one of the practice problems today, and it actually has ticked off the box no. Okay, so I'm just going to delete this because it was just for explanation purposes, but that's just how we would go about entering the data for that. So I'm going to delete that. Again, I've had many profit sharings, but they're usually with banks. A lot of people have profit sharing from banks, and there's no way that they're specified employees. We don't see a lot of this. I have never seen it before. Have you ever had it, man?
No, not yet.
Did you even remember this?
Yeah, I always hated this subject.
Well,
I always dreamt of owning like 60% of HR block shares, and then that would be applicable. but I wouldn't care then.
That's right. That's right. Well, it's odd. I find it odd that this was not talked about in theory, and I might give some feedback about. I don't really think that you should be entering new theory into the TPS, right? Yeah, exactly. So anyway, but I'll make a note of that in my my list of suggestions for next year. All right, so we have many different types of income, as you can see. We've already put in the T3. Oh, here's the T4 profit sharing that I did. I'll just delete that. So Lillian has a T5 slip from the Bank of Canada. You can see on the next page of second page, or page 3 of the in-class exercises. So it's pretty straightforward. A lot of times you do have boxes that you have a T5 that only has one box. So we have a T5 Bank of Canada, and it's interest income box 13. Pretty straightforward filling it in. So then we have another one, Bank of Montreal. So you can enter these in as we go along. Bank of Montreal T5, again, another box 13. And then the next one we have is going to be a T5 from Bell Canada Enterprises. So again, we've got dividends, and then we have, that's all we have on here on the Bell Canada is dividend income. And again, they want me to tell you that you only have to enter in box 24. This is reminder number 5. So they have their bee in their bonnet about this. So I'm also going to point out that T5 slips can report foreign income in box 15 and foreign tax paid in box 16. So let's just look at that right here. So here we have T5. So it says here that you can, foreign income could be right here. Foreign income. No, we don't want this slip. Sorry, let's just go to here. Yeah, here. So if you do have foreign income, it would be entered here, foreign income box 15. So this is very similar to what we saw earlier. Could be dividend or interest. You notice there's no business income here. It's dividend or interest. And then box 16 here, it was going to be dividend or interest income. I have to say that most of the foreign income is on the T3s. I don't think I recall really doing T5s that have foreign income, but you could have the same there, amount there. They also want you to put in, if there is a foreign tax credit, they want you to put the country in. So if we go to here and they want you to put in, is there a tax treaty? Well, we know that there's a tax treaty with the U.S., and they want you to put the country in also. And again, like what we saw with the T3s, if it says that it is no tax, we know that it's interest income, foreign interest income. All right, so let's go to a T3. We're going to go to, they want us to select a new T5 here, and we're going to enter in box 1,000. Again, this is not in your in-class exercises. Enter $1,000 on in box 13, but we selected T5 US. So we're going to, again, I showed you before, there's the exchange rate. We're going to select the annual rate, and we're going to type in 1.2535. We have to put in 1.2535. And so then we're going to go to the worksheet to find out. We're going to go to the worksheet. And the worksheet actually has the investment income here. And this is what this is great because over here it shows us on the T5 we have U.S. income of 1,000. It shows us the exchange, and it shows us the Canadian equivalent. So that makes sense. Actually, I don't think I did that right. There's 2 ways of doing it. I could have actually done it. Let's just change this to just T5 and that rate, and that will get you the same result. See, same result, $1,000 an exchange rate, so that's the Canadian amount. We also have a report here, a summary of foreign income. So we did have on that T3, we actually have the foreign income, interest, and it actually shows on a separate report also. All right, so next topic, we're going to go to a T5008. Hopefully everybody remembers this from our theory, and they gave us in the in-class exercises, we have a T5008 from Investor's Edge. Now, we do recall that T5008 can report investment income and capital gains. So, so in this case, we have box 15 actually tells us what is the investment income. And in this case, code 15, let's see what it means. We go to here, we go to type of security, and these are all the different types of securities that could be represented on a T5008. The most common one would be the debt obligations, so that would be like a T-bill, something that would mature in less than a year. It could be a month, 3 months, 6 months. We could also have units in a mutual fund. This is not the case. Or we could have shares. So if it was shares, the code would be SHS. If it was mutual funds, it would be MFT. And in this case, it is a debt obligation. So we would select debt obligation. Now, all they've given us is box 20 and 21. So I actually went in and we had a discussion last night, and I'll go back to that, but I selected that. You don't need to do that, but I will show you. And you don't need to do this either. I'm just going to take that out. It's not, we don't have to fill that in. So in this case, we only have box 20 and box 21. So can anybody recall what this means? Do you understand what's going on here? This here is an investment. It's not a capital gain transaction. It's an investment. So it's going to show investment income. That's right. Thank you. It's a T-bill. That's correct. That's correct. It's a T-bill. So the difference between the maturity of the T-bill, which is 21, that's the proceeds of disposal, and what the person paid for it, the difference is investment income. Exactly. That's what it is. So that's what we would expect to see. That would be $312 we would expect to see as interest income. So the one thing we talked about last night that somebody asked a good question, sometimes you can sell your T-bills before they mature. So in that case, you would have part of the income would be capital gain and interest income. Now, we don't teach that anymore, which is a shame because I love this part of the course. So, but our software, this is before the software is actually says here, was the security sold before the maturity date? So if it was, then you're going to get a capital gain or a capital loss because part of the proceeds, if you sell it before it's mature, will be interest and some of it might be a capital gain or loss. But we're not going to deal with that. It is unfortunate that they've taken it out of the curriculum because I thought it was interesting. So that's why I selected it, because somebody actually did ask that question last night.
I thought this was investment topics, correct?
It is.
Yeah, I know it's not level 1 or 2. It's
no. It used to be in level 1. I remember it, and
really?
Man, I can go back and find. I got all my old textbooks.
Yeah.
I have a bookcase with all my old textbooks. So yeah, did you ever get taught this at all?
It was on interest, on investment, and not.
So maybe it was in level 2, maybe.
Yeah.
Okay, maybe it was level 2. But it never used to. I remember doing these calculations. So anyway, but somebody did ask it last night. So anyway, so let's go look at the tax return for Lillian, and let's go look to see where we can see that. So we're going to go for 312. So we're going to look onto this sheet here. Oh wait, no, it didn't show that. Federal worksheet. No, it's this one. It should be here.
Second page, yeah.
Where is it? Yeah, there it is, right? The T5. No, I don't see it anywhere. It didn't go to capital gains, did it? Yes, it did. Screwed up. It went into the wrong.
We didn't select the type.
Yes, I did. Right here.
Yeah, sorry, I didn't see it.
I did. Well, oh, yes, you're right. Here.
Yeah.
You're right. No, treasure bill. Okay. It worked last night. It's weird. It shouldn't have gone on there. So This is why we have to look at our data entry to see, did I make a little mistake? What am I expecting? So it should be here. No, again, here, worksheet. Why is it not working today? It worked yesterday. There should be here. Oh, there it is. Right there. Sorry, it is right here. So here we are, interest, and we see all our entries. We see the T5008, and we know that it should be showing interest and not capital gains. That's right. It's right there. So T5008 312. That's interesting. It didn't show. It didn't say to do that data entry, and I didn't do it though. I guess you have to select security type. So it was a T-bill. Yep, okay, good.
Can you delete the sale before maturity? Maybe
yep.
This is what it turned it off.
No, it worked last night, man. I don't know. Anyway, whatever, maybe. It should be security type. Maybe it was that. No, anyway, we're just going to move on. Anyway, so that is what so it's important to look back and see, is that what you're expecting? Oh, actually, there is more information here. So we've already done that. We should enter the name of the issuer. We did do that. Yes, that I didn't select. No, I did do 2015. And box 11, they want you to, yeah, they do want you to do box. No, recipient type. It says here we should do recipient type. I didn't know that. Okay. And data for boxes 2021. Sometimes we do have outlays. So in this case, there aren't any outlays, but certainly because this is a type of disposal, like if it was used for capital gains, you could put in the broker fees. So, but in this case, we don't have them. So the important part about here is that what happens if this is a 0 here, or nothing's been put in here? This is blank. If this was blank, what would happen in our on our tax return if we put nothing in there? True, exactly, it would be huge. So inevitably, a lot of these slips come through and they do have nothing in the cost, sorry, nothing in the cost value. But that doesn't mean that the client paid 0 for it. What it means is that the information is missing. It wasn't filled in for a variety of reasons, and now the taxpayer's obligation is to do the research and find the right amount of the cost. And as I mentioned when we were talking about this in theory, clients get very upset because they want to come in, finish off their return, and they're like, what do you mean I need this information? So a lot of times they need to go back to their broker, or perhaps they had received a statement, yearly statement, monthly statement showing this, but they need to do it. We cannot do it. And I've had many instances where people argued with me about it. I remember it's one woman, she was so mad at me, and because she had to come back 2 days later, and she was still mad 2 days later. And I mean, it wasn't my fault, but and then she didn't want to ever come back to me. But I did have one gentleman, and he had huge investment, and I basically said to him, this is the impact. If I put 0 in here, you're going to owe this much tax. And when he saw that, he really put the pressure on the bank, and he got the information. A lot of times we can't get this information for the client. The client needs to get it themselves. So they also caution us in here that due to the complexity of the income reported on a T5008, you should be very careful when completing the return. And if the code, which we already saw, if the code here is actually a shares, then it is really significant to have the adjusted cost base, and then in that case the income will go to the Schedule 3. And adjusted cost base issues as well as capital losses are beyond the scope of this course. And I think Nan's very happy about that. So, all right. So let us close this one up. Okay, so we've put most of that stuff in. So the next topic is what happens when we get investment income that is not on a slip. So a taxpayer may have Canadian source interest or other investment income that's not reported on a T-slip. Examples include bank interest under $50, so banks don't have to issue a T3 or T5, and you could also get refund interest paid by the CRA. Normally this will be on a client's notice of assessment. This kind of income must be reported on line 12111. So let's say that Lillian's on her 2020 notice of assessment, she was paid $65.10 in refund interest from the CRA. She needs to report it. So you're going to see that we have a slip type. I'm going to close all of these here. And then we actually have an investment without T-slip. You can go to your Smart Start, and you can see just under the T-slips here it says investments without having a T-slip. So let's all select that. So here we are, investments without having a T-slip. So let's go to the first entry. So the first drop-down menu, we're going to select either interest from Canadian Sources Bank, bond interest, or this one here is Canada Savings Bond, Quebec Savings Bond, mortgage interest. I'm going to select interest from other sources. It actually used to say at one point CRA interest, didn't it, Nan?
It is, if you go down.
Oh, if I go down.
The second one from the bottom.
Oh, here, interest on any tax return. Okay, so you can do, in my notes they said to pick interest from other sources, or you can go interest on any tax received. Either way, it's immaterial. So, but I'm going to mix this up. I'm going to actually take this out and just do it with you. Yeah, take it out right now. Okay, so we're going to have CRA interest here, and in this case, it is 6510. 6510. CRA refund interest. It's funny, in the notes it says here, there is the other option, tax refund received, which can be used, and it's more specific, but interest from other sources has long been the option that most of you will use. I always use CRA interest, okay? Yeah. Either way, it doesn't matter. So we're going to put the amount in there. So then, what else do they want us to do? So that's that one. So let us... Okay, so let's say we have other interests. Let's go interest from Canadian sources. And if it was U.S., so we can add bank. Let's just add bank interest here, bank interest. Interest of, let's say it's $50. So let's say it was in U.S. So if the amount is in U.S., if the Canadian interest isn't paid in U.S. funds, it should be entered on this line here. So let's just say we got some more interest, and you would put it here. You'd put it here in U.S. Enter. Why is that not entering? Yeah, and then it will translate it because it will do an exchange calculation because you've entered it on the U.S. line. So that's one way of entering investments without a slip. What if you got dividends? So if you got dividends, Canadian dividends not supported by a slip, you would put it in here. And if you notice the little message on the bottom, or it says here, enter the taxable amount of the dividend. So if it's non-eligible dividends, it's going to be grossed up by 115, but if it's regular dividends, it's going to be 138. It actually does tell you that. Where is it here? Oh, here it says here. So this would be dividends. They want you to put the taxable amount in, and here is the another line. This here would be at 138, and it looks like this one would be at 115. So it's going to calculate it. It's not going to calculate it for you. You have to put in the, you have to gross it up. You can't put the actual amount in. You actually have to you have to put it in by calculating it. And it's actually listed in your TPS manual, how to calculate it. So the gross up rates are 115 for regular dividends, and the other ones for the eligible dividends are 138. So if the dividends are entered, we'll go to this line here, Canadian dividends, we enter, this is U.S. amount, U.S. dividends, then the TPS will convert it. And again, you have to put the taxable amount in. You can't put the actual, so that's a bit of a liability with this, that you have to put the taxable amount in. Let me just double check that. Canadian dividends.
There's no gross up on the U.S.
What's that?
I said there is no grossing up.
No, I know.
Legals, yeah.
That's true. Oh, that's right. But it has to be U.S. dividends. The taxable amount must be identified. The thing is, the U.S. you do not get a dividend tax credit with U.S. You do not get a dividend tax credit. So that's the problem with U.S. dividends. Okay. So, again, I already showed you foreign investment income is reported on line 12111, regardless of whether it's interest income or dividends. So that's the big difference, too, is that U.S. dividend income is just reported like regular income because there's no different tax treating. So that's why foreign dividends must not be entered into the investment section. There's no foreign dividend tax credit. And actually, it gets very complicated. I remember taking foreign dividends, and there's some weird things that can happen in a much higher level course, which was interesting. But we're not going to talk about that. So again, you're probably not going to see this a lot. The most you're going to see is bank interest, and you're going to see CRA interest. I've never had many slips that had, people don't report this usually. What do you find, Van?
Very rare. It's only just the CRA interest.
Yeah, I hardly ever get any dividends. Hardly ever see that. So, but that's how the TPS does it. So, anyway, any questions on that? Because we're done with how to enter investment income. Okay, so we're going to go on. We have a question earlier. They don't know, Abby. Abby has a great question. How would the CRA know if the bank interest earned is under 50? They don't. So basically, the banks are following the rules. The rules are they don't have to they don't have to issue a slip. Just because you don't have a slip, it doesn't mean that you shouldn't report it. Is the CRA going to go after you for $20? No, probably not. But we're here to advise you how to prepare a proper and correct tax return. And clients are supposed to report bank interest. So, I mean, it could be 3 cents, right? You're supposed to report it. So, and of course, I don't think the CRA would know. Anyway, good question. So we're going to go to carrying. I'm going to close this now. We're going to go to carrying charges. So basically, taxpayers with investment income often incur investment expenses, and they may be claimed as carrying charges. So how are we going to do it in TPS? Well, this is how we're going to do it in TPS. We have a data entry on a Smart Start called carrying charges or investment expenses. So let's go to our Smart Start, and it is kind of in the middle here. I always find this is the one right here. Right under moving expenses is called carrying charges and investment expenses. So we're going to select that. I've already selected it. And so let's open carrying charges. So we have different things that we can report. We can report, the first line here is interest paid on loans to earn investment income. So in Lillian's case, she took out an investment loan and she's still paying it back. And for 2021, she was charged $168.50. So you can put that in. We also have another, once you enter one data entry screen, it brings it up so you can do it a second time if you need it. We also have the management fees. So in other investment expenses, we have a drop-down menu. It could be management and accountant fees, or it could be fees paid to investment counselors or other carrying charges. So we noticed that on her Horizon, her T3 for Horizon investment, there was a management fees of $285.50. This is where you would enter it. Also, this is where we would enter if there were legal fees related to support payments. So if somebody I don't know why they put this in here. It's just kind of jammed in here. So that's where the deduction would be. So anyway, so those are our carrying charges. So let's look at let's go to the tax return, and we've entered all her T3 slips. We're also going to see on line 221 the carrying charges. So here we see carrying charges of management fees and investment loan for Lillian, and the total amount is $454. And then let's just go look at her tax return. So her tax return here shows her employment income, all the dividend income. Again, I may have stuff in here that you don't have, so we're not doing this exercise for accuracy, but we do see the carrying charges deducted online. So I just wanted to show you that. All right, any questions on carrying charges? Because we'll move on to the next topic. So the next topic will be RSP contributions. So when where did I get 168.50 from? I got that in my notes. It's not in the in class exercises. It was just in my notes. Yeah, so it was 168.50 and management fees. So when we do our when we open up a return, we have pre-selected data entry screens, and we have the RSP one. So here, so the next topic we're going to do is how to put in RSP deduction for Lillian. So Lillian, you'll see in the in-class exercises, it does say October 31st and February 21st of 2022, she made contributions of $3,000 and $1,000 to the Royal Bank. So we'll go into our data entry screen. We're going to select, it allows you to put in RSPs for your own plan or a spousal plan. And in this case, Lillian, it's her own plan. She is a widow, so own plan. Then we have the choice of when 3 different boxes here. We're going to put our contributions in from March to December 2021 and January to February of 2022. So what happens if the client comes in and they have a contribution from January and February of 2021? What are we going to do with it in 2021? What are we going to do with that contribution slip? Let me know in the chat. That's correct, Irene. We are not going to include it on the tax return. If we actually put something in here, we would actually get an e-file error, all right, because we can't make a deduction for that. So, in this case, we have a $3,000 contribution for her for the first 10 months, and then we have $1,000 for the next. Memo is used for when we're doing a T2205, and we will see that in future TPS chapters. I don't know which one. They said it was chapter 11, but it's not. Anyway, so we are not going to use that. That will trigger an e-file error. So again, you have to file an adjustment, and you will see this a lot. People will come in because they tend to get those slips for the first 60 days of the year late, and then they think it applies to that period, and when it actually doesn't. So a lot of times, a lot of these RSP slips are missed because they come too late, or people have filed the returns and not realized that it was applicable to 2021, and they actually thought it was 2022. So you will get that a lot. So you'll only use this in a very specified situation. So these are the 2 entries we're going to make. So this is what we have for Lillian, RBC contributions of $3,000 and $1,000. We also have to put in her RSP deduction limit, and that is given to us in the problem. It says it's in the exercise, it's $12,476. So we're going to go to the other box, and which will ask us, is this for a spousal plan? No, but room and limit. So we're going to put our room and limit in as $12,476. If we put nothing in here, she would not be able to deduct any RSP. It's very important that you put this in. So let's say I'm going to leave it at 0, and I'm going to go to her tax return, and I'm going to see that there's no deduction for RSPs. And there's probably a note in diagnostic here telling me, oh yeah, the RSP schedule indicates you have excess contributions. That's not true. We just didn't put in all the information. So let's go put that back in again, $12,476. So it also tells us, when we're looking at our notice of assessment, that she has undeducted RSP contributions. So we're going to go back to the first data entry box here. So underneath the contributions, we have a box called undeducted contributions. So it can be from previous years or January or February of this year. Well, we don't know. I've never used this undeducted contributions from January, February. Use previous years because we don't know, and put in 300. So all right. So the taxpayer does have a choice not to deduct the undeducted contributions. Sometimes taxpayers can do tax planning and they would save it for another period. Okay, so Bonnie has a good question. So basically people have undeducted contributions. I do believe we talked about it in theory. It basically is contributions a taxpayer has made and they never deducted them. So they've actually put the CRA knows about it, they've claimed it, but they put it on their tax return, but they didn't actually deduct it. And there could be reasons for not deducting it. It could be that I want to put in, I'm only going to take enough to maybe reduce my taxes, but I'm going to save it for next year. I'm going to give you an example of how this is valuable. I had a client who mother died and he had huge investment income. So what he would do is he would go to his financial planner and they'd say, look, they couldn't figure out exactly how much RSP contribution to put in to reduce his taxable income to zero because he had investment income and then he'd have a deduction of RSP. And so he would put, an amount in. And then when he came to me, I would only deduct enough so that to reduce his taxable income, and then he would some had left over. So the leftover would be undeducted contributions. So then he could save that to next year because you don't want to waste an RSP contribution. You don't want to put an RSP contribution on someone's return when they have no need for it. And people do that. So undeducted are meaning contributions you made in a prior period and they were not deducted. So the other thing that you can do is you can choose how much you want. So in this case with my rich gentleman, if his limit was 12,000 and he only needed 10,000, then I would put this in. I would do RSP to deduct. So you can put in any amount, you can put in an amount that makes sense, right? So if you have somebody who doesn't need to deduct anything, you can put it as zero, and basically you're telling the software not to make any deductions. So I know this is a lot, like maybe you wouldn't do it right away, but sometimes you do find yourself in a situation that you would do that. So right now we know that Lillian has the room. So if I put in $0 for Lillian in RSP to deduct, I'm going to look back to her return, and I'm going to, let me just see if they actually say anything about it, notes and diagnostic, that we've chosen to do that. No, they did not. Let's look at a return. So now you'll see that there's no deduction for RSP. So if I go back and I'm going to just delete, I'm just going to remove this because yes, she does want it. There should be a deduction here of $3,600. So you can play around with it, and it does happen. Sometimes people put money in their RSPs and they have relatively low income. You have to report it on the return, but you don't have to deduct it. It's possible, Bonnie, to do that. They could put it in the tax-free savings. Again, it all depends what their intent is. I know with my rich gentleman, he would just use that for the next year, so it made more sense to, he didn't want to pay tax, and he was putting the investment income into his RSP. So sure, they could do that, but a lot of times people, like I will do this too. I will, I go to my broker or my investment person, I say, put $4,000 in, I only need $3,500. I'm okay with putting it in and letting it carry forward and stuff. So a lot of people don't do that. They don't do this type of financial planning because they don't know about it, because they're not thinking ahead. So, but it's a good tool to use. So let's go back to this is the data entry. I don't know if it's a lack of education. Yeah, I guess it is. Some people are more involved in their finances than others, and it's getting good counsel for sure. Absolutely, we definitely need to do more financial management in the education system. But that's another topic, right? Good point, Bonnie. So the thing is, what I want to make it clear to you is that the TPS does not issue a warning if the taxpayer's non-refundable tax credits exceed the taxable income. Therefore, it's really important to get in the habit of comparing the the non-refundables to the taxable income to see if it would be more appropriate to reduce the RSP deduction in the tax year. And this is what a good tax pro will do. They'll be constantly looking at it. I remember I had a gentleman came in and his wife's income was like under 10,000, and he made an RSP contribution in her name. And so he couldn't even, it made no sense. No, in her name. It wasn't even a spousal. He made it in her name. Why are we putting RSP contributions into the wife? I didn't understand why he was doing this. I don't think he knew what he was doing. So let's double check our entries for the RSP. So we have two areas to look at. We have the Schedule 7. So let's go to the Schedule 7 and make sure that it does show what we expect. Lillian had undeducted contributions. Here are her contributions made in the first 10 months and then the last 2 months of the period. So her total contributions are $4,300. She doesn't have she does have a home buyer plan, but we haven't. Let's do that. They haven't talked about a home buyer. Let's just ignore that for a moment. I don't know why they're asking me to do this without doing the data entry. So I'm going to ignore that, and we're going to do the next part, and then we'll go back. So Lillian also has a home buyer repayment. So you'll notice that in the very last line in the in-class exercises. So let's go to home buyer. Home buyer plan. So how are we going to find home buyer plan? You can type in keyword H home buyer plan, and that should bring it up. Or I tend to just go to the Smart Start, and we're going to go to home buyer plan, whichever it's already grayed out. We already have it here. So let's open it up, and basically the information again. Do not believe what comes through in our software, the carry forward. You always double check. And you always go by what's on the notice of assessment and what comes through on the AFR. And on the notice of assessment, if the person does have the home buyer, it will show all this information, but it will come through on the AFR data always. So a taxpayer can always designate a higher amount as a home buyer repayment, provided that there is a sufficiently high contribution has been made. So you can definitely enter in more than what is the required payment. I don't have many people do that. I really don't. So in this case, Lillian did a withdrawal of $10,500, and she has an outstanding amount of $6,300. And you get all this information from REPA-Client, by the way. Her designated payment is, her required payment is $700, and she only wants to designate $700 of RSP contributions on here. So, next thing here. So what would happen if Lillian didn't put in her RSP contributions? So what would happen if she made no RSP contributions? I'll answer that question in a moment, but I'm asking one now. So let's say she made no RSP contributions and she had a required payment of $700. That's right, it would be added to her taxable income for the year, even if she did a partial. So if she only did $500, then she'd have $200 added to her income. I've only ever had once in 10 years somebody who wanted to pay this off really quick, and we did that for her. So the question here is, if the contribution is less than $700, it's say only $500. So how is requested to repay? So let's say that so basically it's only $500, then there wouldn't be any RSP deduction at all. I do believe we have a practice problem that will relate to that. So I hope I've answered that question. If the contribution is less than $700, then there would be income online. It actually shows you on here. Yeah, it'd be the difference. Thank you. So now let's go to Schedule 7 and see how Schedule 7 plays out now. So we do have her unused contributions, and we have her contributions. So she has total contributions of $4,300. She has a home buyer repayment. Her required payment is $700. Therefore, she only has $3,600 to deduct. So that makes sense. So her RSP deduction will be $3,600, and there's nothing to be carried forward to a future year. We're also going to go to another schedule, RSP Schedule 1 and 2, and this is the TPS calculates this. And basically what it does is it calculates what your future or the RSP room after this year, because you have more. She has more room being created, so it actually has calculation of the RSP contribution limit for 2022. So again, this is just an estimate. However, we would not use this number. Sometimes people might want to know what is the estimated RSP, how much room do I have now? I think it's better to wait until you get your notice of assessment and always go by the CRA's calculation. Do you ever use the schedule very much, Man?
Just sometimes, yeah, I just check it just in case there's something off.
Okay. So Abby asks, the textbook explains how to compare the 335 to line 60 to see how much RSP is needed in the current year. Well, that's what we just talked about earlier. Let me just go back to that. We talked about it earlier, is that, you know, we could have people who put RSP contributions and they don't need it, right? So basically you're looking at your non-refundables will exceed the taxable income. So then you wouldn't want to put an RSP contribution in. So that's basically what we're talking about here, is talking about the case in which somebody's non-refundables exceed their taxable income. So in that case, it would be a waste to put in a deduction for RSPs. So that's what I was trying to say earlier. You're comparing the line, your total non-refundables, to any taxable income, and maybe you don't need to use any of the RSPs, or sometimes you'll use some of your RSPs. So does that explain that, Abby? No, there won't be anything like this on the exam. But Jilly, I remember once I had a client, and she had, like, let's say she had $60,000 in income, and she separated from her husband, divorced. She got a lump sum payment. She put it all in her RSP, and she wanted to deduct the whole amount. When I put the RSP amount in, it brought her income down to about $10,000 or $12,000. And she got a huge refund, and she got Canada Worker Benefit, right? So that's what I'm talking about. Those situations, you need to really look at it closely, like, especially if it's a lower income person, and you're looking and you have an RSP deduction, and it's not, it doesn't make sense to take the deduction. I haven't seen this very often, but you know, it is something that you could see. All right, so there's also a parallel to the RSP is the PRPP, and I'm not going to go into it because I've never seen it. So, I mean, I guess you could put in, I wonder if there's a separate, they said to show it to you. I've never done it, and I'm not going to go. They didn't give me any notes, so I'm not going to do it. We did the home buyer, hallelujah, home buyer. Apparently you can do, I'm going to show you this. Open up the RSP. You can actually make contributions to an athletic trust. So 2021 income paid into an amateur athletic trust. Again, I've never seen it, but that you would put an entry in here. So one of the last, we only have a couple more topics, and then we're going to go to the problems after our break, of course. So I've just got 2 more sections. And so we're actually done with Lillian. So what we're going to do is open up Dave Duncan. So let's open up Dave Duncan's file, and Dave Duncan is right here. Here we have Dave Duncan, and I don't know if you remember Dave, but I do believe he had moving expenses. So what we're saying is that Dave is a first-time home buyer. He purchased his home on 2010 Chipmunk Crescent, and he didn't own a home in the last 5 years. Therefore, he can claim the home buyer amount. How do we enter home buyer amount? We're going to go to our Smart Start, And I think it's right around where where is the home buyer amount here? There it is, right down here under employment expenses, home buyer amount. So we have the home buyer amount. I'm going to cancel that. So home buyer amount, and he could claim the full amount, or you can claim a specified amount. So in the case of if there's a spousal situation, the spouses we can determine who better to claim it, or it can be split equally. If Dave happens to live with an unrelated person, a friend he bought the house with, then they can decide how they're going to split it. And so this is how the DT Max, you can either claim the full amount or a specified amount. That's pretty straightforward. All right, so it can be split between spouses and common law partners and between unrelated parties. So that's pretty easy. So, but we're going to stick with Dave, so he's going to claim the full amount here. So the other thing about Dave is that he received workman's comp for 2 weeks. He had an accident in work in November, and he received a T5007. So let's go to T-slips. In T-slips, we're going to have T5507s. So on the T5007, we have workman's comp reported or social assistance. And in this case, we have workman's comp, and we have an amount of $678 for Dave. That is on the in-class exercise. So box 10, $678.50. So if you can enter that, then we're going to go to the tax return. And we're going to ignore that. We're going to go to his summary, and we're going to see that, yes, workman's compensation has been entered in income, and then it is deducted before we get to taxable income. So it goes in and out. So that's then the same social assistance would be handled in the same way. I just want to remind you the part about if you have social assistance and it's a spousal situation, even the social assistance must be reported by the higher income spouse. So let's say the lower income spouse actually received the social assistance, the software will transfer it. And I remember it happening once in the office to a senior tax pro, and she was going out of her mind because she couldn't remember it. This is you hardly ever see that, but you know that's something that can happen. If there is a spouse, a family situation, and the social assistance is in the on the slip of the lower income spouse, the TPS has to be transferred to the higher income spouse, and our software does that automatically. All right, so we've now completed all our data entry demonstration. So are there any questions of what we've covered up to this point? Okay, so what we're going to do is I'm going to go back to my PowerPoint, and we'll just sum up our PowerPoint. We did all these discussions. We had them all. So I'm just going to recap right now. We've covered everything. So at the end of this chapter, we should be able to make necessary entries to report different types of investment income and claim carrying charges. We'll be able to enter investment income slips from Canadian sources that are not reported on T-slips. We'll also show you how to enter investment income reported on a T5008. We also showed you how to enter RSP contributions, either for a deduction or a carry forward. We also showed how to apply home buyer and lifelong learning repayments to a tax return, regardless of whether the taxpayer has made an RSP contribution or not. We showed you how to make the entries to claim the home buyer amount and how to properly enter workman's compensation and social assistance onto a tax return. So our next part, okay, so for next Tuesday, read Chapter 21. You don't do the in-class exercises. If you want to enter the personal information, just so you have it done before the class, that's fine, but you don't have to do the problem. But don't do the in-class exercises. So we're basically done, and then when we come back after our break, we will do the practice problems, and yeah, we'll have more than enough time to do that. So we're going to go for a break, and I'm going to stop sharing. And we'll write our break time down here, going for a break here. So break. Oh.
Here we go.
We like nagging. Okay, so all right. So are we? Okay, so before we start, I'm going to go to our textbook. So if you have, if you can get it up, I'm going to go to Inkling. I'll bring it up and I'll share my screen in just a moment. There we go. And I'm going to share my screen, my desktop. And here we are in Inkling. And I can see that the session is in progress. We're reporting. We're never, ever letting that ever happen again. All right, so I'm going to go to Tax Library here, and let's go to our Fundamentals textbook. And we're going to go to the very last, we're going to go to into appendixes. So go to your appendixes, and I'm going to show you that we have the function keys are there, we have frequently used keywords, but we have Appendix C, transfers, optimize, override. So this basically explains to you how you go about doing transfers, optimize, override. We are not going to discuss override because there should be very, very limited situations, and we're not going to deal with that in this course. So basically to optimize is used on the taxpayer or their spouses to adjust the default transfers. And transfer override is used on a dependents file to activate, suppress, or redirect transfers. So when you go into it, here's an example of the transfer. What exactly are you going to redirect, or what are you trying to do? Most cases it has to do with eligible dependent, caregiver amount, disability amount, medical expenses. They wouldn't have UCCB designations anymore. Then we have how to use the transfer. So it does explain some things about how to use this properly. So the first part was about transfer override, and then how to optimize. And here it shows you all the deductions and credits that you can optimize between the spouses. So please, this would be definitely worthwhile reading it and to understand it better. So this is quite an explanation. Ignore the override. Notice what it says. Override should only be used as absolutely necessary. It's a last resort. I've only seen maybe one or two instances where an override has to be used, and usually it's in a lot more residency you would use it to override things. So, but it's very clearly in a procedure. So again, you're not going to see that, so I'm not going to discuss it because we're not going to see it. So please, here's your resource material. So the other thing I want to show you too is I'm going to go back to our library for 2022, and I'm going to go back to the provincial supplement. You're probably thinking, Leanna is out of her nuts. Out of her mind, she's nuts. No, I'm going to go to the provincial supplement because in the provincial supplement, we do have TPS entries. So I just wanted to show you, as you can see along, here I am in the provincial supplement, and you can see along the side, the sections in it, they'll have little TPS entries. So while we're not going to be covering TPS of the provincial supplements in this part, I'm going to start adding some in because I want you guys to do it. We don't really have an opportunity to do it, but I thought, why don't we look to see which ones we would put in. So I'd like to show you the Ontario Seniors Public Transit. I'm actually going to write these down, so make sure that I do it with my other class too. So I'm just going to do the ones that we will see more frequently. But again, if you're in the office and then you have some provincial credit, you can always go back to your resource material. However, I will show you some of them. Let's just look what TPS entries are they showing us. They're showing it for the elimination of education amounts. So let's go for education amounts. I'm not sure if I'm going to have an example of that. Then we're going to see community food program, political contribution. I'll show you that. Political contribution, pull through shared tax credits, no. Cooperative, no. That's for, I'm going to show you the homes. I don't think they have it for home safety. Let's just go senior home safety. Okay, and then we have public transit, Ontario Senior Public Transit, definitely show you that. But the bigger one is the lift credit. We've already discussed, no TPS for that. I'm going to discuss the Trillium benefit, so definitely TPS, and so that's the one I really want to focus on. All right, so anyway, so I just wanted to point that out to you, that not only are you getting the theory for provincial supplement, you're also going to see TPS in there. So I'm just going to forget that, and I'm going to bring up my TPS again. So now we're going to do the practice problems. So let me know in the chat who did some of them. When and how can we have the course textbook? So the sheet, I understand that in mid-January that every student will get a PDF of the textbook. I don't know if you're going to get a PDF of the provincial supplement. I don't know if you're going to get the facts and figures. So I would suggest that maybe you print it out yourself, because I don't know. Again, last year we were able to buy the textbooks, right, through Staples, and this year it's not available. And certainly we've let the Tax Academy know that a lot of students do want a textbook. So again, I don't know if you're going to get what I just showed you, the provincial supplements. Okay, great. So Lorraine says that she has done problem 20-3, and you know what? This is all part of learning, because you know, when you do a problem, when you do a problem and you have issues with it, you're not going to forget it. So anybody else? Okay, so everybody's done them. Okay, so can you just let me know if most of you have done them? Basically, what we're advised to do is that, you know, give you time. If we were in the classroom, well, I would give everybody time to work on it, and I'd answer your questions, and then we'd take it up. So what I did last night was I wasn't sure if my students, they're not very responsive in my evening class, and I said, here's the problem, we discussed it, and then I gave them 5 minutes. So I don't know if you guys want me to do that or not. I know for recording purposes is probably bad, but just let me know if people need time to work on the problems. Okay, so some people didn't do them, so okay. So I think what I'm going to do is that we're going to discuss the problem, then I'm going to give you 5 minutes, and then we'll do the problem. All right, so personal information is easy. These are relatively simple problems. Okay, you're going to watch me, Bonnie, are you? Okay, all right. I'm so exciting to watch, am I not? Anyway, okay. All right, sure. If you want to do that, that's fine. It's, you know, so a lot of times I would redo these problems when I was learning. I would redo them for sure. So anyway, okay, so our first problem is going to be George Raymond. And George here is a computer programmer for New Ideas, a company that has an employee profit sharing plan. What does that mean? It probably means we're going to have a T4AP. I wonder if he's a specified employee. Anyway, George's grandmother passed away the year before. As a beneficiary of the estate, he was allocated some of the interest income for which he received a T3 slip. In order to put a down payment on his condo a few years ago, George had withdrawn $15,000 from his RSP, of which he'd already paid $5,000 back. His 2020 notice of assessment indicates that his required repayment is $1,000, and his RSP deduction limit is $26,090. He only made a contribution in the amount of $400 to his RSP the end of February 2022, and he has a receipt for that. So George's T-slips are produced below. Even though George is a Canadian citizen, he wishes to answer no to the elections question. So again, I encourage you all to analyze and figure out, what am I looking for in this problem? Well, number one, we have his T-slips. He has a home buyer plan. And I just want to comment on the wording of the problem. It tells us that he had withdrawn $15,000 from his RSP, of which he'd already paid back $5,000. But the data entry for the home buyer says how much is outstanding. So you're going to have to do a calculation here. So let me know in the chat, How much is outstanding of his home buyer amount for George? What is exactly? So they will do that regularly in these problems, and they may do it on the TPS exam, but just don't get tripped up on that, because that can lead to, they'll ask you they might ask you what box number. Now the other issue for George here is that his required repayment is $1,000. And yet his contribution is only $400. So what effect is that going to have on his tax return? That's right. He has a deficiency. There's going to be, I think Abby said, I think it's 600, Abby, not 700. I think you probably just had a typo like me, right? Okay, good. And then the other, hey, don't be sorry. Don't be sorry. I do it all the time. As you can see, all my errors are on view for everybody. The other thing here is that George says he doesn't want to be added to the election list. So what are we going to do? What are we going to do on the tax return? That's right. Boolean is correct. We're going to go to the elections keyword and we're going to select no. And we do have people in the office that do say no all the time. I have them all the time. So anyway, so let's also, okay, so we've analyzed the words. We have a T4 slip for new ideas. And we can see that I will highlight the charitable donations. So he has some donations on his T4. Next, we'll look at his T4 profit sharing. We'll see that there are dividends there. We see we have a capital gain, and we have other employment income. And we'll notice that the box specified employee is tick marked no. So we don't have that issue. We also have a T3 with capital gains and other income from the estate of Alice Raymond. And then we also have another T5 from TD Bank. So this problem, it's going to be testing us on our, it's going to be giving us practice, I shouldn't say test, practice on how to enter the T-slips. So, of course, I've already got it done and fixed up from last night. And that's probably why I'm faster in the morning than I am at night. So let's go to Raymond, and I can see that I've done so many returns. I'm going to find Raymond. So I'm going to type it into here. His last name is Raymond. So let's go. I type in Ray. Oops. God, I screwed that up, didn't I? Okay, Ray. There we are. There's Raymond George. So I think, I can't remember what the consensus here. People don't want to do it. They just want me to cover it. So you know what? I will just go through it relatively slowly. All right. So here is George. Here's his personal information. His email address is there. He's given it to us. We don't know if he has a My Account and wants to receive it online, so we're not going to put anything in there. We have his mailing address. So I'm going to close that. We're going to go to the election field, and we're going to select that he is a Canadian citizen, but he does not want to be added to the elections list. Right, so we're going to close that. We're not going to go to the accountant right now until we analyze the return. Here's his T4. Well, again, we notice we have his charity, and we're going to tick off the first box, which tells us that we've double-checked our entry. Let me just quickly scan. Pretty sure I did it right last night. And I put the correct FIT or income tax in for Ontario, and we have the charity. So next, next we're going to go to a T3. So we have a T3 here for from the estate of Alice. We have box number 21, which is capital gains and losses. All right, capital gains and losses, and then we have box 26 with its other income of $680. Pretty straightforward data entry. Next, we're going to go to the T4 profit sharing. So the profit sharing, we see that we have dividend income eligible, and we should really doing this too, double checking them. The first income box of each slip should be tick marked that we double checked it. So in this case here for profit sharing, we have our dividend, we have profit sharing income, in box 35, and then we have box, that was box, oh yeah, we have box 35 and we have box 34. I wish they were in numerical order. And we have our dividends. And then we have selected, we don't actually have to select specified employee. Yes, no, it's not. I mean, you can put no in, but if you're leaving it blank, it assumes it's no too. All right, so that's our data entry for our profit sharing. Then we have the, go back here to the T5, TD Bank. We have our dividends and we have the interest income. So that is the data entry for the T5. All right, so we've got our T-slips in for George Raymond. So, but we also need to go back to our notes, and it tells us that he has a home buyer. So again, and he also has his RSP deduction. So we'll go to the RSP section and we select own plan, and his contribution was made in February of 2022. He made $400 to the TD Bank. We also need to go in and put his room and limit in, and his room is 26090. So that's pretty much the data entry until we get to the home buyer. So here we have our home buyer information. So we have the withdrawal was $15,000. The RSP outstanding is $10,000. Now they didn't give us that, so what you could do here, I'm just going to take the data out. You can actually go plus $15,000 minus the outstand what he's actually paid, and we can do the calculation in here. You don't have to bring up the calculator for that, but the nice thing about the boxes in TPS, you can do very simple arithmetic. You can do two things, right? You can add or subtract. That's pretty much. I think you can actually multiply too, but I use that feature a lot. Do you use that a lot, man?
Yeah, I do.
Yeah, we use that a lot. Yeah, it's for very simple stuff, right? Then we have the required payment is $1,000, but what we've designated is $400 because he only contributed $400. So he could have had more than $1,000. He could have, if he had more of an RSP contribution, he would be able to reduce it down. Most people I find don't want to reduce it down. So basically that is the data entry for George. We have his T4, we have his T3, his T4 profit sharing, we have his T5, we have his RSP deduction, and we have his home buyer. So let us go back and look at the return and see what is our bottom line, and does it make sense? Does the return make sense to us? Here's our personal information. Here is the total income for George. We can see that he has employment income. Then he has other income. These are mostly all boxes from investment. You'll notice that we have the RSP income. So that $600 is what we discussed earlier. That's the deficiency for the home buyer. So it has to be, he only put 400 in, so he has to put 600 into his income. So his total income is $63,908.17. So those of you who've done the problem already, that should be your total income. If you didn't get that number, you know that there's something incorrect with your data entry. Let's go to deductions. We have a deduction for the CPP enhanced. You'll notice there's no deduction for RSP because that had to be applied to his home buyer. So his taxable income is $63,625.77. What are his non-refundables? He gets to claim the basic personal amount, CPP, EI, Canada employment amount. We have the donations of $125 that are on his T4. And so then we have his amount payable. This is the amount he has to pay. And then we compare that to the income tax deducted, and he has a balance owing of $1,059.70. So those of you who did the problem, were you able to get this result? Okay, awesome, great. Yay! Cecil's excited. Yay, I'm excited for you too. So, all right. So, next part. Does this make sense that he owes money? Let's look. Does it make sense? Let me know in the chat. Why does he owe money? And believe me, he's going to want to know. He's not going to be a happy camper unless he expects this every year. So why does he owe money? That's right. Bonnie, correct. It's the home buyer plan. That's correct. He had to include $600 into his income. Has to pay tax on it. He also has a lot of investment income, and we know investment income. There's no tax withheld. So we would expect this. And he has no other, all he has that could offset it would be the donations, which aren't enough to offset it, right? So let's go to our data entry. We're going to go to the accountant section, and we're going to go to notes annual, and we're going to write in balance due to income from T3s and T5s and the home buyer plan repayment. There you go. So that explains his tax return. Now, I'm also going to look at his income and say, his total income is about $63,908. Chances are he's not going to get any benefits. So the software does calculate benefits. So in his case, it doesn't show anything. There's no GST calculation. So here, if you look way at the bottom part of the tax return summary, it will show whether he's getting any Trillium benefit or any climate action or anything. So he's not getting any GST, but it does show that he is going to get climate action paid out to him in 373. He doesn't get any other benefits. So in this case, I'm not going to demonstrate any rent or property tax paid because I know it's going to be irrelevant. So I'm going to wait to do it on another tax return. So any questions about practice problem 20-1? Okay, how to change the status ready to print to ready for e-file. Again, you don't have to worry about this in the office, but basically what you do is you go to data entry, you go tools, recalculate current client. If you want to change it, you're going to go to file. I think you go into data entry, you go to save and close. So if I go save and close, notice it says ready to print now. So save and close. Again, I wouldn't worry about that. Just a second here. My alarm is telling me it's 11 o'clock. That's usually when I have my breakfast. And I don't have breakfast at 11 o'clock when I'm teaching. So Lorraine wants me to go back to the investment income. Her capital gains are wrong. So let's go back to the return for George. And let's go to T3. So this is the data entry, so I don't know how much. No, I'm not. I have a coffee in the morning, Bonnie, and I have a cream in my coffee, so that keeps me going. Anyway, so this is the data entry here. So if you didn't get the capital gains, you said you think you got the capital gains incorrect. This is the correct, so data entry. Okay, good. So, so one of the questions is from Quinn Wei. Any suggestions for him saving the tax? Sure. Well, what suggestions do you have for George? What suggestions do you have? Yep, more RSP. That's right. Now, some people actually don't want to do that because it costs a lot of money, believe it or not. Number one, we can tell them, please put the minimum in. Like, really, when you do not put in your minimum required amount in your home buyer, the whole purpose of taking the money out tax-free from your RSP, you've just, negated it. So this drives me absolutely crazy in the office. And so many people forget it. I always remind people to do this. So in his case, absolutely, that would make a big difference, right? Now, the second thing is that, knowing that is he consistently having investment income, he may go to his workplace and ask them to take a little more tax off. But you know what? Some people don't mind owing, but again, he could put money in his RSP to wipe it out. So, if you want, I can let's go into his RSP schedule and let us put in some, let's say I'm going to add, just for demonstration, let's add some RSP. Let's say $5,000. So you can this is how we play around with this all the time. People come in February all the time. So he'll have a refund of $422 with a $5,000 deduction. So let's just adjust that because we don't want to have too much of a refund, right? Let's put in $4,500. So what's the magic number? He's still getting a refund, so he wouldn't have to put that much in. So let's go to 4,000. I don't think 4,000 would be enough. No, he still has a refund. So, he could put 4,000 in, but, some people don't have 4,000 sitting around. So anyway, so I'm going to take that out of my problem here, that he did not put in anything here. I'm going to delete that. So anyway, okay. So any other questions about George? Because I think we're done with George. I don't know if I would put tax-free savings for George because there's no tax advantage for him. So I probably wouldn't do that. So let's move on to practice problem number 2. Okay. So this is for Doug Nielsen. So let me bring up Doug Nielsen here. There we are. There's Dougie. There's Dougie. There we go. Okay. So let's just close all the data entry screens here. And this here is his personal information. So we also want to put his email in. It's been given to us, so let's read about Doug. For several years, Doug worked for Simply Consulting as an office clerk. Unfortunately, his employer closed the company at the beginning of the year, and Doug lost his job. Unable to find new employment immediately, he started collecting employment insurance benefits in February. When his EI ran out at the end of October, he still hadn't found a new job. He had no choice but to apply for social assistance, which he received throughout November. Finally, he was able to find another job at Taylor Contracting, and he started working December 1st. So already this tells us he's probably got 2 T4s. He's going to have a T5007, and he hopes to have a big refund. And I got to tell you, I hate this in the office when people say they want to have a big refund, and then they end up owing a pile of money. Anyway, again, we're not responsible for that. He does want to vote yes to the Elections Canada question. So are we going to have to do anything in the software to respect his wishes? No, we don't have to do anything because the default is yes. So we're not going to have to do anything there. So now it says prepare his return for e-filing. All righty. So we're going to go to, there's his mailing address. Going to put his mailing address, and we're going to go to his T4. Going to close the mailing address. So he's got 2 T4s, and again, we're going to double check our data entry, and then I believe that when you put his information in, it does ask you to recheck the CPP contribution. So that's why there's an additional tick mark there, because we want to clear that. We don't want to have any yellow triangles here. We have to clear all those. So there's the data entry for Simply Consulting and for the second T4. So now we have a T4E. So we're going to go to the T4E is under the T-slips, and we have T4E, and he has a repayment rate of 30%, and he received $15,480. So we have to put that in box 14 and 15, and we have to put in the FIT, which is $980. So that's the data entry for the T4E, and then we have the data entry for the T5007, and in box 11, we're going to have to put in $618. So that's basically the data entry for Mr. Nielsen. So let's go and look at, now he wants a big refund. Drum roll, please. Let's go to his tax return summary. We have employment income, EI. We have his social assistance that goes in and out. He has no deductions from income at all. So basically his taxable income is $21,915.25. He can claim the non-refundables, personal amount, CPP, EI, Canada employment amount. He has no other refundables. How much tax does he have to pay? His calculation for federal tax and provincial, he owes $1324.30, and yet he had income tax deducted of $1791. He has his CPP overpayment, and he also gets the Canada Worker Benefit. So he is getting a refund of $1,558.14. So anybody else get that, or did you have trouble getting the refund of $1558.14? Yay, great. Great, a few of you have gotten it. That's great. And if you're going to be doing it at home later, you know what you need to get. So, all right. Does it make sense? So does the return make sense for him to get this much of a refund? And if so, what is the reason for his refund? True. Yeah, Bonnie. That's right. So he worked for one place for how many months did he? February. So he worked for 1 month for the first place, and the other month for the other place for 1 month. So they taxed him as if he was earning that all year. So that's why you would expect more to be taken off. And because his income was low, he is entitled to the Canada Worker Benefit. That's correct. And he also has a CPP overpayment. So let's go to our data entry screen, and we're going to look at the accountant, and we're going to type a note. So here in this case, we have refund due to Canada Worker Benefit, only worked 2 months, additional tax. Oh, bless you. Wow. It must be all the dogs running around in here making you sneeze. And then we have a refund for the CPP overpayment. So that is definitely why. That's reasonable. So, I mean, I feel so bad for Doug here. I do, losing your job. At least you found a job. But the government's going to step up and give him some benefits, right? So if we look just below his refund, it tells us that he's getting the GST credit. He's going to get climate action. Now, I did put in something for the Trillium benefit. So this is additional information. Just trying to show you how to put that in. So I'm just going to close everything, and I'm going to go into basically the Smart Start for each taxpayer for Ontario. It does come up with provincial credits. So we have provincial tax and credits here. We also have provincial property tax credits. So I'm going to just show you how to do the data entry if he actually pays rent. So I'm actually going to take this all out, and we'll put it in again. All right, I'll just take it out, delete it, and then I'll show you how to do the data entry. But what I also want to go back to his return and just show you that without any rent, he's getting the sales tax credit. So how do we see this? We can see that there, along the left side here, we can see that there is a calculation for the GST calculation. It's based on income, and the software calculates an estimate. And so it's only estimated. And you know what, we let people know that in the office. It's important that we have an estimate. So basically that is his estimate of his GST credit, and then we have a schedule of how it's going to be paid out. And I do let clients know that, especially if they get little or no refund, right? Then we're going to go to the Trillium benefit. Again, an estimated amount for his Trillium benefit. It automatically, because of his income, he is entitled to the this amount here, the estimated Ontario sales tax credit. So he's going to get $324, but we also have the part of the estimated Ontario energy and property tax credit. So that's what I'm going to show you how to do that data entry. So in this case, we're going to go to the provincial property tax credit, and when we bring down the drop-down menu, is he an owner or a tenant? Is he a student in residence? is he living on a reserve, or is he in a public non-profit long-term care? In this case, I'm going to say that he's a tenant. So let us select tenant, and then we're going to put a street in. So we can actually go back and we can probably, here, I'm going to open this up. No, I'm going to open this up. But what I'm going to do is I'm going to copy this. I can copy this, and then I can paste in here. Paste the address, so I don't have to do the data entry, because I know I make lots of mistakes. There we go. And then the postal code, I'm going to copy that and paste. So some people don't bother even doing this. I always do, because, oh, shoot, sorry, I didn't do that. Did the wrong paste. I think maybe I can't do that with postal code. Let's see if I can copy and paste. No, it won't let me do that. So I have to enter it in, which is probably why I don't do this. I just type it in myself. Anyway, so the software asks us how many months did the renter pay rent. It cannot exceed 12 months. You could have instances where somebody does end up renting for more than 12 months. However, you can only put 12 months in. If you put 13 months in, the system tells you, if you do that, you can't see it because it's gone on my other screen, but it tells me that the value is too high. The range is from 0 to 12. So in this case, we're going to put in 12 months of rent, and then they're going to say how much rent is paid. And again, we can do a calculation here. See, a lot of times people don't pay the same amount of rent all year, so you could have 5 months at a certain rate and 7 months at another. We're just going to say for him, we're going to go 12 times $1,000. We'll say that he paid $1,000. So that will do the calculation for us. This field is not relevant. Is this a long-term care home? No, it's not. Ignore it. Who's his landlord? Landlords. A lot of times people don't even know who their landlord is, so I'm just going to type in landlord. And of course, then there's the most important question is, does he want to elect to receive his lump sum payment a year from now, rather than being paid over the course of the year? And I haven't had a single person that ever wanted to wait a year, so we're just going to ignore this question, right, man?
Yep.
Yeah. Who would? For me, I'm like,
why? The question is why.
Why? Yeah, I haven't had anybody who wanted to do it. Honest to God, if I have money coming to me, I want it now. I don't want to wait for a year, right? So Anyway, so that's all we have to enter for his rental. Right, so let's go to the tax return now, and we'll go back to the Trillium benefit calculation, and you'll see that now we have in occupancy costs. So I remember doing this when I was a student and doing this whole calculation and realizing I got no credit at all. It was just so painful. Anyway, so in this case, basically there's a 20% of your occupancy cost, and then it's offset by other things like what your certain credits, and they calculate it based on your income. So in his case, he paid $12,000 for rent. He's going to get a property tax credit of $551, which is pretty good. So that is added. You can see here in the very bottom part here, estimated Trillium benefit. So he has his sales tax credit. He has his property tax credit or rental credit, and he's entitled to $875. And remember, in the good old days, it used to be paid onto your tax return. Now it's not. It's going to be paid out monthly. So our software calculates what's the monthly estimate. Now, if the amount was $360 or less, the taxpayer will get a lump sum payment in July of 2022. But at the minute it's over, it's sent to them monthly. So that's how we do enter in the rent. Are there any questions about that? So I just want you guys to know how to do this, because I don't think we were never taught this in level 1. I don't remember doing this. You just kind of learned it the hard way. But anyway. So that is George's return. So, oh, sorry, it's not George. We're on Doug. We're on Dougie here. So anyway, we're completed, Dougie. If there's no questions, I'm going to move on to 20-3. So this is Reginald, Morrison, and Ingrid. This is a little bit of a tricky one because the client says they don't want to file a tax return, and yet she really should file a tax return. Okay, so let's go to the Morrisons. So I'm going to bring up Reginald and Ingrid here, and I'm just going to do something in Ingrid. Just ignore what I'm doing here right now. No, here, just ignore. Yeah, I'm going to go to here, and I'm going to go to, not going to do that. I'm going to just say, I'm just going to clear this. Delete this keyword. I'll show you that later. Okay, so let's go to Reginald and, so let's look at the problem here. Reginald and Ingrid, we have an address, we have an email, phone number. Reginald and Ingrid have been married for many years. Reginald works as an event organizer for your city and has his office at City Hall. His T4 is displayed below. Ingrid won a considerable amount of money in a lottery some years ago. Oh, lucky her. She invested her winnings in bonds and mutual funds. Her only income comes from her investments and occasional babysitting for two of her neighbors, for which she was paid $1,800 in 2021. Her T-slips are reproduced below. So what does this tell us about Ingrid? She has some casual income. So we're going to have to report that, right? So where are we going to report that? What line are we expecting to see that? Correct. Line 10400. So we're going to have to put in her casual earnings. Now, due to a childhood illness, disease, it says, Ingrid has a walking impairment. However, her condition doesn't qualify for the disability tax credit. So what does this tell us? What can be claimed for her? Even though there's no disability tax credit, what can be claimed for her?
Yep.
Correct. She said the caregiver amount. Exactly. So then we get to the next part. It says, since she expects to have neither a refund or a balance owing, she is not going to file a return. And then we find out that Reginald wants to answer yes to the Elections Canada question, and we know it's the default. So I know this caused problems. So I know we talked about related party. So what we're going to talk about that even though she does not want to file a return, she has a lot of information that we should put in because we want to optimize. The returns. And, you know, it's hard to optimize a return when you're doing related party. So in this case, we've already determined that, you know, the caregiver amount can be claimed, probably this full spousal amount can be claimed. If we do a related party, we're not going to be able to look at that information. The only thing that's going to show up on Reginald's return is, you know, the spousal amount and less his income. Then we're going to have to add all that up manually, so it doesn't make sense. So in this case, we're not going to use related party because she has income slips and there's other things we can claim. So let's say the client says, no, I don't want to file. She's not going to file, doesn't want to pay the money, and which is fine. We still have to enter the information in the TPS. So we're basically going to do a return and not charge her. It probably didn't do all of them. So, but I don't see how you could get all of them. You shouldn't be able to get it because if you did
her dividend tax credit.
That's right.
Yeah.
But I don't know how you can't put anything in for her at all because how do you put that information in a related party? Yeah. So I know. So that's why we're doing these problems. Okay. So how would you get the caregiver amount? That's right. We should really have slips to input, right? So yeah, so we're not going to use related party. Really, related parties for people who, which we use it a lot, but it's usually in situations of taxpayers who go to separate people. They don't do the tax returns together, and they usually have good income, so there's usually not a lot to optimize, right? So in
Yeah,
this case, oh, go ahead, man. Go ahead.
I say in this case, it assumes that we have access to her T-slips.
Yes,
We
that's
cannot
true
do
too.
this without her approval. We can tell her we need the
That's right.
information, but we will not file. Without that, none of this would work, and the related party would be the only solution.
Yeah, and then we're not going to do the best job for the client
Yep.
because in this case, how do we tell the software in related party? There's nothing to select in related party that relates to the caregiver amount. So really the taxpayer is going to lose. So anyway, so let's go back. We're going to respect the wishes. We're not going to use related party, but we're going to create a file for both Reginald and Ingrid. So that's what we're going to do in here. So you should be able to go in. I know I can't remember who it was earlier. Was it Lorraine that said, how do you delete things? So basically, you're going to go in and you're just going to take related party out, and then we're going to have to add. If you did have the Ingrid in already and it said it was inactive, you'll have to go in and reactivate. All right. So I think you go in and do that. I've done this so many times. I'm going to reactivate her. So if there is a field coming up, you need to reactivate it, or you can just delete it and start again. So let's go to Reginald now. So let's look at his T4. On his T4, he has RTP, and he also has union dues, so $650. All right, so we're going to expect those deductions on his return. Now let's look at Ingrid's slips, okay? So she has a T3, and you'll notice on the T3 for Scotia Trust, it has dividend income, and it has capital gains, okay? So this is the issue with this problem, really, and she has other income, capital gains. So I'm going to take you back to the rules. Let's go bring up our Inkling. And we're going to go back to the rules from our very first chapter, and we're going to go to Chapter 1, and we're going to look at who needs to file a tax return. What are the filing requirements for the tax return? And look what it says. An individual must file a tax return for a taxation year if they have tax owing. Well, Ingrid, she probably doesn't, but she has disposed of capital property or she's realized a taxable capital gain. Because if you look on her T3 slip, box 21, she has capital gains. So in this case, really Ingrid should file a tax return. And I'll just let you know there was discussion on the instructor board, and somebody brought this to the attention of the Tax Academy, and they said, maybe it would be best not to, put in some capital gains, or that she has an option. In this case, she really should file, but we're not going to force it on her. I mean, really, if a person doesn't want to file, they're not going to file. But, if you had this in the office, you're going to do major CYA. You're going to say, client was told that she needed to file a tax return, but she didn't want to do it. We're off the hook. This is her relationship with CRA. So in terms of a problem, I think that they complicated it unnecessarily. And so I'm going to say that, of course, she should probably file a return, but you know what? We're going to just prepare her return. And there's nothing else on her stuff. She has her T5s and her T. Yeah. Okay, so let's go to Reginald. So we have his, we'll enter his personal information and his mailing address. So for those of you who are following along, I'll give you a minute or two to do that. So hopefully they'll adjust this problem so it's less confusing. Let's see what else here. Okay. Okay. So she can transfer the cap gains to her spouse and then absorb. No, she cannot do that. No, she can't. You'll notice on the, so Zinju says she can transfer the capital gains. No, she can't. There's no rule about that. No, she can't. Can't do that. No. And if you look at, if you look at her slips, you'll notice that on her slip, she's the only one listed. And if you look on the very bottom part of the T3 for Scotia Trust, it says the beneficiary code. It means one person. That means that only one person is on this account, and it's got her social insurance. You look at the T5, the same. On the T5, on the right-hand side, box 23, recipient type is 1. Only one person on this account. So no, she cannot do that. If she can, it's not beneficial. No, she just can't do it, okay? Now, the dividends are a different story, which we will see, but cap gain is not. So again, I mean, she said she won the money. I don't know how, how when you're in a relationship, and if she won in the lottery, wouldn't that be family? I don't know. I'd be just like Ingrid. If I wanted it, it'd be all my money. What would you do, man?
It's my money regardless who wins it.
That's right. It's your money. That's right. That's right. So, anyway, it can't be a very good relationship between these two. anyway, okay. So enough fun and games. Okay. So, so we have the personal information for Reginald, and all he has is his T4, and we're going to double check our data entry by marking the first box. And we have our fit and we have our due. So that's basically all we have for Reginald, right? So we're going to go to Reginald and we're going to go to Ingrid. I'm not going to talk about his refund until we put everything in for Ingrid. So here we have Ingrid, and we didn't put a separate phone number for her because it looked like it was a phone number shared by both of them. And there's no email for her because it says Reg, so we didn't put one in for her. So what income does she have? Well, she has the babysitting income. So we're going to put that into other employment income, and that is $1,800. And then we have her T3. So we put all her dividends in, her other income, and her capital gains. She has a T5 from Bank of Canada and another T5 from Scotia. So there is her employment. How did I get spouse of Reginald? I don't know what you mean. I went in. I added it. I just go to, again, you go here and you add a new family member and you select one of them. Is that what you're talking about? I just selected spouse of, and it automatically, it just said spouse of, yours didn't say that? No. She's linked. No, she's linked. Yeah. Okay, so that is her data entry, but we also have the fact that she has an infirmity. So we're going to select infirmity, and we're going to, they did mention in the problem what it is. It's a walking impairment, but we know that the disability amount, she cannot claim it. So, but this is how, and again, we could answer yes to the caregiver, but we don't need to because the software is automatically going to add it. So let's look at Ingrid's result here. So here we have Ingrid, and we have her other employment income, we have the interest income, and we have the taxable capital gains, and we have other income. What income is not here? We had some dividend income of $772.80, and it's not here. How come it's not here on Ingrid's tax return, even though we put it in? Why is it not here? Yes, it was transferred to Reginald, right? Because it was more beneficial. She can't take advantage of that disability tax credit. So the software automatically transferred it to Reginald. So we don't have to do anything about it, right? It went to Reginald. But, and I think that in the notes and diagnostic, it actually will tell us. So that's why it's really important to go and check the notes and diagnostic. And it actually tells us that DT Max has determined that it's better for one spouse to report all the taxable dividends the spouse or common law partner received. We can only do this if by including the dividends in the spouse's income, he or she will be able to make increases claimed for a spouse or common law partner amount. So it actually says to us the software optimized, and it said the dividend income should go into Reginald's return. So if Ingrid had not is not filing a tax return, we wouldn't be able to do this. If we use related party, this would not be done. We would not be doing a complete and proper tax return. So Ingrid, of course, so we have her other employment income from her babysitting. She basically has no tax or refund, nothing. Really, there is no reason for her technically, but because she's got the capital gains, she really needs to file a tax return. So we would tell her that, and if she chooses not to, that's fine. We won't force her to do it. So let's go to Reginald here, and let's look at Reggie, and let's look at his tax return. So we have his employment income, and there is the dividend taxes from his wife's return. So that's his total income, and he has RPP deduction of $3,500. He has his union dues, and he has his CPP. That all makes sense. That is what we were expecting. Now we have his taxable income of $64,182.30. Now let's look at his non-refundables. He has a personal amount, and then he has a spousal amount. He also has CPP, EI, and Canada Employment amount, and there is the dividend tax credit. So he didn't have charitable dividend tax credit. So he is actually getting a refund of $24,26.28. So I know a lot of you struggled with this one just because of the related party and, you know, Ingrid saying, I'm not going to file a tax return, but really we do have to enter her data. So was anybody able to get that refund or not? It's okay. I mean, the whole point of doing these problems is that you struggle with them, you come in, you see, and then you do them again, right? So that's the refund we're expecting for Reginald. So, yeah, exactly. So with a good point, Abby. So Abby did it. She got a refund of $23.71. So we increased his refund by almost $100 or so dollars, right? So. Anyway, so let's go back to our, let's look at here. Where is the caregiver amount? So he can claim the caregiver amount. Where are we going to see the caregiver amount that Reginald can claim on Ingrid's behalf? Anybody in the chat? Where are we going to see it? Exactly, Cecil. It's going to be Schedule 5. So let's bring up the Schedule 5. We go to the Schedule 5, and for common law partner, we can see the personal amount from 13,808, and we see that we add the caregiver amount, so it increases the personal amount that can be claimed for Ingrid, lesser income, and that is the amount we can claim. Exactly. So that's where the caregiver amount is. All right, so let's go back to his return. So basically, Reginald is getting that refund. They're not entitled to any benefits. Their income is clearly too high for anything. So I'm not going to demonstrate property tax credit or rent because they're not entitled to anything. Their income is too high. And but they will get the climate action. So the question in the chat is, why is the dividend income went to the higher income spouse? Anyone want to answer that question in the chat? That's great. The reason it's not due to low income for Ingrid, well, I guess it is. It's just that in case of spouses, the government allows you to, if they have relatively low income, and like Abby said, it increases the spousal amount. It is beneficial to have it transferred to Reginald because then he can claim the disability tax credit. Otherwise, the disability tax credit in this case, with Ingrid having such low income, it's lost. That's right. So Lorraine, you've got it. So yeah, exactly, exactly. So everybody, that is in our theory. So you can go back and check in your theory textbook. We did talk about this, and I think we did an example when we were doing covering the theory. So anyway, so are there any other questions about Reginald and Ingrid? We have one last problem to get through. Yeah, no problem. I love all your questions. It's great. So it shows that you're learning and you're reinforcing everything. So it's great. I love questions. I hate it when I don't get questions. Okay. Anyway, okay, so now we're going to do, the next problem is going to have optimization. So we'll have a little practice with optimization here. So our next one is the Simons. So let's go to the Simons here. And yeah, oh, there they are. There's Joseph Simon. So we'll go Joseph here. So here we have Joseph Simon and his wife Jane, and they have been married for many years. Their only son Jason was born on July 8th, 2011. So we probably are going to put him on the tax return because there could be some expenses. So we're going to add him. We're going to have Joseph's return. We're going to have a file for Jane and probably a file for the child. Joseph and Jane are both employed during the year. However, Jane only works part-time because she also supervises Jason when he does his homework in the afternoon. Such a bizarre explanation. Joseph's notice of assessment has the following information. We have his 2021 RSP deduction limit, and he has undeducted RSP contributions. Then we have some information about Jane's notice of assessment, and we have her deduction limit. In October of 2021, Joseph and Jane each made an RSP contribution in the amount of $2,000 to their own plans at the TD Bank. In 2021, Jane incurred the following medical expenses for herself, which were not covered by their health insurance. So she had some glasses and she had some dental. They're all in the same year, so we don't have any issue with selecting the most advantageous year. Jane wants to claim all the medical expenses on her return, and it said that she donated $384 to the foster parent plan during the year, and in previous years, she would like to have the donations claimed on Joseph's return. Jane and Joseph are Canadian citizens, and they want to answer yes to the Elections Canada question. So then we have their slip. So we just have two T4s, basically. So So let's, so I have Joseph's return up, we have his personal information entered, we have the mailing address entered, and then he has his T4. So let's look at the T4. Here's his T4. We have the correct fit entered. He has dues and charity. So not only do they have a charitable donation that was not on his T4, we also have a charitable on his T4. We also have the medical employee paid. So these are employee paid premiums. So this is considered a medical claim. So in addition to the glasses and the dental, we're also going to have this as part of their medical expenses. So we also know that Joseph contributed to his own plan, so we're going to go to the RSP section, own plan. They said they made the contribution in October of 2021, so we're going to put $2,000 in, and it was the TD Bank. We also have been told that he has undeducted contributions from previous years. We don't know which year. We're just going to put in under previous years, 458. We also need his RSP deduction room. If we had no room there, he wouldn't be able to deduct any of his RSPs. So we also have the charitable donation. So you certainly have the choice of putting it on Jane's return or on Joseph. So again, the software will optimize. So let's say that we put it on Jane's, the donation, and it was more beneficial for Joseph, the TPS would transfer it. So I want to demonstrate that. So we're going to put the donation onto Jane's return because she paid for it, and we're going to see what the TPS does. So the entries for Joseph are his T4 and his RSP. So let us go to Jane. So Jane, again, you're going to go to family members and you're going to add a new family member. Mine's already done, so I can't add another spouse, but you will add a spouse to the family head. So spouse, and I'm not going to do it because it's already here. So here we have Jane. We have her personal information. No need to enter her mailing address, and there's no need to enter a phone, but we did get a email, so we'll put the email in here. It looks like it's under Jane's. They're not consistent here, but they put it under Jane. So I'm just going to ignore this control, first of all. So let's put her T4 in. So she works for Green Image Landscaping, and we'll put her, she has no deductions on here. We also, so that's for T4. We're also going to add the RSP deduction for her. So we have her own plan. And she put in the first 10 months of the year. In October, she put 2,000 in, and we're going to put in her deduction limit of 8,342. Now, the interesting thing about this here, we're talking about what is her income should she have made it. You can see that she did have adequate income, so it would make a difference to maybe make a contribution to her RSP. I mean, I probably would have. I don't know why you would want to do that, but anyway, whatever. It would have been better to put a spousal amount in. They would have had a better return. Anyway, so we're also going to follow what it said in the problem. We're going to add the medical expenses to Jane. So we have the glasses of $450 and the dental of $87.75, and then we're going to go in and add the donations. So foster parent plan $384. So those will be the entries for Jane. So let us go to the tax return and see what are we seeing in the tax return. So let us look at Jane's return first. There's her income. She has an RSP deduction of $2,000, CPP enhanced deduction. This is her taxable income. So she can claim the refundables of personal amounts, CPP, EI, and medical expenses. And it certainly makes sense to have her claim them because she has the lower income. Therefore, the threshold is lower. So in this case, she can claim the medical expenses, and then she still has some tax payable. And then the income tax deducted was $1,524. So we end up with a refund of $1,201.67 for Jane. So was anybody able to do this problem and get that amount for Jane? Oh, interesting. Yep. Okay, good, good. Interesting. Apparently in Saskatchewan, the TPS automatically claims it on Joseph's return, so then that's why you would use Optimize. So here in my instructor copy, it actually shows that they should be claimed, but the default is actually it's going to go on Jane's anyway. So if you'd put it on Joseph's return, it would have gone on to Jane's return anyway. And I think that for good practice, you should put the medical expenses on the return of the person making the claim so that if they are audited in the preseason, we can find the information in the file. So otherwise, you're like trying to find both of the returns, and filing can be quite an issue in the office. I don't think it's in our office, right, man? We're really good at filing things,
Yep,
but
yeah.
I remember being at another location, and it was like tearing hair to people just didn't know how to file alphabetically. Oh my God! So anyway, and then in terms of if we had put the donations, they were put onto Jane's return. And let's just see, where are the donations? You'll notice that the donations are not, even though we put them on Jane's return, you'll notice that the TPS didn't put it on her return. So let's have a look at our notes and diagnostic. So our notes and diagnostic, it actually says that DT Max has optimized, or is selecting who is the optimal person to claim medical expenses. So they're saying Jane should claim the medical and the donation should be claimed by Joseph. So even though she said what TPS is doing, we're double checking that, yeah, it does make sense, right? It does make sense. So that's the value of always reading the diagnostic report. So here we have Jane, so we have a refund of $12,167. Does this make sense that she would have a refund? And why does it make sense that why does she have a refund? What are we going to put in our notes and our accountant for our analysis? Medical expenses, RSPs, correct? So let's go here, refund, refund due to RSP medical. But you'll notice somebody's just said charity. So Lorraine, the charitable donation actually went on to her spouse's return because it was more beneficial. So in her case, her her refund is due to the RSP deduction and the medical expenses. So we're done with Jane. So let's go to Joseph now. So Joseph, we didn't have to use any controls, but let's go to look at his return. And we're going to see that here is his employment income. He has an RPP deduction, and he has an RSP deduction. He has his union dues, and he has his enhanced CBP deduction. So that's his taxable income. He gets to claim personal amounts, CPP, EI, and employment amount, and you'll notice the donations are here. So he himself has a refund of $822.98. So $822.98. You'll also notice that there's no claim for his wife because her income is too high, right? So he can't claim anything for her. So his refund is $822.98. So let me know in the chat if that was, if those of you who did it were able to get that refund. Okay. So again, so if some of you didn't get it, so I would just note the total income and taxable income, and then you should be able to figure out what it is. Especially take what you calculated and subtract from that refund, and you can maybe find out where the problem is. So now let's go and analyze his return. So let's go back to why does he have a refund? So let me know in the chat an explanation for why he has a refund. Okay, so she looks like he got that. That's great. Looks like you got it. Okay, so why is there a refund? RSP, that's right. And what was the other thing that went on his return? Correct? He had an RSP. So shared the donation, that's right. So he had RSP contributions and the carry forward. That's what his refund is due to, RSP contributions and the donations. Exactly. So let's save that. So you'll notice that we didn't have to use the controller optimization because the software automatically optimized it. But I just want to show you is that what would happen, I'm going to go to Jane's return, and I'm going to go to the controls, and instead of medical, I don't need medical, I'm going to click on here and select charitable donations. I'm going to change it. And then what is the control? Okay, that's fine, I'm going to do that. Control, I'm going to say that Jane's going to select all of them. Oh, I did this last night. Just let me find my answer here. Okay, so basically what I'm going to do here is that with the donations on Joseph's return, the refund between both people, for both of them, the total is, I'm going to add them up here because I should have done this separately. Okay, there it is right there. I still have the numbers in my calculator from last night. So I'm going to add them both up. And whoops, 1201.67. So we're going to get the refund between both of them is $2,024.65. That is with the donations on Joseph. But now I'm going to say claim, own, and spouse's donation. I'm going to have them all onto Jane. Let's see how that changes the picture a little bit. So now I'm going to go to the tax return summary with both spouses. So I'm going to see Jane and Joseph, and we can see here, we can see that the medical are on Jane here, and now I put the donations on Jane here. So how does that change the refunds? You'll notice that the refunds have changed. So Jane's refund has gone up from $1201.67, but her husband's has gone down from $822.98 to $675, and the total income, the total refund that they received is now $1984.64. So by not optimizing, they actually are getting less of a refund. It's not a big deal, but let's subtract the 1984.64, and it's a difference of $40. So by putting the donations on the husband, they end up with more of a refund. So I'm going to take that out now because we don't want to optimize in that way. I'm just going to remove it and go back to what we had. So I'm just demonstrating that the optimization. This is really what we want in the program if we've optimized it correctly. So, and in this case, I can see that the income between them is their net income is $64,000. They're not going to get any benefits, right? So let's look here. Oh, we also didn't add they're not going to get any benefits except, the CCB benefit, and they're also going to get the climate action. So the one thing that I didn't show here, because they didn't actually, there's no child care expenses, but we're still going to add the child. So again, you're going to add a dependent, and we see that there's Jason here. So add a new family member. We're going to add a dependent link to the family head. So hopefully you did that. And let me go to Jason's return. So basically it's there's no information to add. I'm just going to change his province. There's nothing here to add. A few years ago, it was really significant because if you had any, there's a sports credit. I don't know how many of you mentioned that, but a lot of people would credit for that, right? So, and this. It's and arts too. I remember, there could be piano lessons or tutoring or anyway. Basically, the only thing they should really get rid of this, but it's because if we're doing prior year returns, we need this. So nowadays, you would only have on the dependent. You might have some income, but definitely child care expenses and tuition and medical expenses if they were over 18. He is not. So again, there's no tax return that's going to be generated for Jason. All right. So we've completed all the practice problems. So we have 5 minutes left. If you have any questions, let me know in the chat. But I'm always so pleased. I can tell you I go home so happy when I'm able to cover all the theory and the problems. I'm very happy. Anyway, little things make me happy. So anyway, so any questions in the chat? 23 still driving me crazy. Can you show us the data so I can take a picture? Sure. I'll go to Ingrid and Reginald. So here is Reginald's. So if you want to, I can make it a little bit smaller because if you're going to take a picture, I don't want it to be too small. That's the first part, but I'll try to get the federal return for, I can't make it much more smaller. Oh, you can't even see it. So I'll just do it in stages here. This is the first part here. And then the second part for Reginald is here. So Abby's saying she's still getting $823.04 for Joseph. Are we not? Oh, okay, I'm sorry, it's a different problem. So Lorraine, yeah, so you can take a picture. So hopefully Lorraine, has you gotten your picture? Because I'm going to go back to Joseph Simon's return. So let me know if you've got your information. Um, so I've got three questions here. So Lorraine, if you can just let me know, show data. Oh, you want me to show the data? Okay, so here's the data entry here. That's the data entry for Reginald. And then if I go to the data entry for Ingrid, so there's the data entry for Ingrid. And then, of course, the infirmity. So there's the data entry for Morrison. So hopefully you've got that. Great. Okay, so let us go here. Let's go back to Lorraine asked about, oh yeah, the data. Oh, so let's go back to Simon, Joseph Simon. So you're saying for Simon you're getting 8.22. So you've got how many cents difference? We're looking at 6 cents difference. So there must be something with your data entry. So I would, if you'd like to just compare your data entry here, unless I made a mistake, I can certainly check mine, but you need to check all of these. So you've got, you know, what are we doing here? We have Simon, so I've got the wrong. Let me look at Simon. That's the last one we just did. So all you can do is check your, my CPP is incorrect. Okay, my CPP 2463. Ah, they put in 30, so 63. There you go. There. Again, I didn't double check it, so the answer is 82304. So I will have to 82304. There we go. And they said they had checked it here. They had a little tick mark. You can't trust anything that comes from Tax Academy. That's for sure. All right, so that solved that problem, and then we have no other questions. Okay, any other questions then? So we have 1 minute. If you have any more questions, I'll hang around. Yeah, we only have 3 chapters. Okay, so I think I'm going to stop sharing, and I'll write on the whiteboard right now the solutions. Okay, so let's go to, I'm going to change the color to blue here. So you send refunds? What do you mean I send refunds? Anyway, so let's do our practice. I'll just do a summary here. I also wanted to mention that we will have the TPS exam in a couple of weeks. A few people have asked me about it, and I've just been reviewing it, and I will do it. There shouldn't be any surprises. But it's basically going to be a family, and so you'll have to have 3 tax returns you're going to prepare, all linked, and again, there's no surprises in it. We're going to be covering everything. So let me just put in the refunds for Joe's Raymond. He owed 1059.70. Yeah, how do we do that? You know, it's so sad not being in the office because I used to always like to bring treats in Halloween and bring in something at Christmas time. So it was always fun, right, man?
Yep, it was.
Well, man doesn't like treats.
Yeah.
You don't like treats, do
No,
you?
I don't.
No, you don't. I love to do Christmas baking, and man never eats my baking. And I that's fine. More for me. Oops, no, I don't like that. Okay, so we have Doug Nielsen. So let's go to here, and we have 20-3. So yeah, it's always fun. End of class. It used to be fun, not anymore. It's more fun to be in person for sure. It's not the same. And his refund is, oops. And I'm going to put Ingrid's too. No, I didn't put Ingrid, so no, I didn't. Okay, so, and Joseph, Simon, refund 823.04, and then we have I really don't like this, Simon. And she had a refund of 1201. No, she didn't.
Yeah,
that was yeah.
So
that's Ingrid's refund. She doesn't have a refund because remember, Ingrid, she had income of she didn't have any taxable income, which is why she didn't want to file her return. So it's basically zero. There's no refund. And we so that's one thing I have to go back to. Okay, so I forgot to show you that, demonstrate. And I forgot to demonstrate that in my class last night too. So Ingrid's no refund. So, and again, the problem said she doesn't want to file, so we wouldn't actually put anything. Just give me a minute. I got to take a picture of this so I can send it out to you also. So, what was I going to do? Oh yeah, I'm going to go back to the return of Reginald and Ingrid. Okay, so I will come back, but I'm going to share my desktop again. I'm going to go to Reginald. Now, so we were told that Ingrid doesn't want to file a return, but we did put her slips in. So we're going to go to the progress tracking. Yeah, we're going to hear. So we're going to go into, so this will happen in the office. So we have somebody, let's say somebody comes in, does their return, and then they find out the fee, and then they freak out and say, no, I'm not doing it with you. What would we do? We would close the file. So how do we close the file? And that's what we would do in the case of Ingrid. So we're going to go here, and we're going to go progress tracking. So select progress tracking and go continue. So we're going to go to progress tracking, and we're going to go. We're going to select progress, and we're going to select that way down here. File is closed. So the file is closed, and we're going to hit enter, and we're going to put a note in here. Why is it closed? Client does not wish to file. I mean, if it was somebody who didn't like the fee, I would put in client was not happy with the fee, doesn't want to file the tax return. So we'll hit enter. Now you'll notice, let's go outside on the client list. You'll notice that, I did it on the wrong one. I closed Reginald. I meant to close Ingrid's. Did I put it on the wrong one? Yeah, anyway, so I'm going to just delete that. I'm getting good practice, right? When I make mistakes, I just say, I'm just practicing, right? So let's go to Ingrid. And you see, Ingrid, it was already there. Oh, no, it wasn't. Okay, so we're going to go back. Smart Start. We're going to select Progress Tracking. And we're going to go down here to select File Closed. And then we're going to say the reason she wants to file it, client does not wish to file. Client does not wish to file. And then we're going to go back outside and we'll see yes. So Reginald's is ready to print and Ingrid's is closed. All right, so that's how you would do that in the office, and we would do that in this case. So I'm going to stop sharing, and are there any questions? So I think we've covered everything for the class. So I'll try to get this weekend. I'm going to try to get the TPS exam done, and then I can say with confidence we've covered everything, right? We've covered it all. So anyway, so that's it for today. If you don't have any questions, well, I'll just stay here for a couple more minutes if you have any questions. So, but we're done. Yes, everybody have a great weekend. I hope it's going to be milder because it's turned mild all of a sudden. It's great. I don't know if it's going to last. I'll have to check on my... You hope it does. What, you don't like the snow, man?
No, I like it, but it's a little bit too early.
Yeah. Too early. Yeah, you probably do all the shoveling, right?
Yeah.
Let me see. It's supposed to go up to 9 degrees on Saturday and sunny. Oh, I'm going to ditch my class. If it's 9 degrees and sunny, I'm going to ditch. Anyway, thank you guys. All have a great weekend. Thank you for showing up and being prepared. I appreciate that. Anyway, so yeah, we'll be back here Tuesday morning. And is the recording still going on, Nan?
Yes, let me know when.
Okay, let's close the recording. Bye, everybody.
Goodbye, everyone.
Yeah, have a great weekend, and thank you for all the reminders to record.
Yep.
We appreciate that.